Hi and welcome to Swissquote's daily market talk. It's Monday, September 30th, and the new week begins with a further rally in Chinese and China related assets on more stimulus measures from the Chinese government. Elsewhere, the US dollar remains under a decent downside pressure before this week's all important US jobs data. But the euro, on the other hand, is also offered quite well as the first set of inflation updates from the major Eurozone countries actually pointed at an accelerated easing in the European inflation figures and revived the expectations that the European Central Bank could do more to help the sputtering underlying economies. All right, so the new week started with another major bull run in the Chinese stocks, guys, as we open our eyes to the new week with more stimulus measures from China. This time, the country announced to further ease home buying rules in three major cities in China: Shanghai, Shenzhen, and Guangzhou. So the Chinese communications construction stocks surged about 7% at today's trading session following a stellar week last week. The CSI 300 index added another 6% and is up by 25% since the middle of September. And the Hang Seng index gained another 3% today. So the Chinese will actually be going on their national holiday in an excellent mood this week, and investors in China, though skeptical that the measures will help lifting the EM giant in the medium to long run, will eventually give some time to the Chinese measures to show in the economic data. Because, data-wise, not that we are not there just yet. Because the previous measures that the Chinese government had announced throughout this year, remember, have barely borne fruit. The Caixin Manufacturing Index, for example, it unexpectedly shrank into the contraction zone in September, and the services PMI is on the edge as well, near the 50 level that differentiates expansion from contraction. And on top of it all, the Chinese EV sales fell 48% last month, and the EU hasn't yet increased its import tariffs on China-made EVs just yet to save its own car makers. But anyway, China and investors are breathing a sigh of relief still. The CSI 300 index had its best week since 2008 after all. Iron ore prices are up by 25% since September as well. And all these good news from China and rising iron ore prices give a decent support to the Aussie dollar, preparing to test the 70 cents level to the upside as Australian stock markets also extend their rally toward the fresh all-time high levels. Now, over here in Europe, growth and China-sensitive European stocks are also having their best time. They're having their share of the Chinese pie, to say the least. The STOXX 600 index closed last week at an all-time high level. Louis Vuitton gained 20% in just a week's time as investors bet that a part of the Chinese stimulus measures and the money that will come to people's pockets will end up in the hands of Louis Vuitton maker, as the first thing that the Chinese will do eventually when they have more money is to buy a Louis Vuitton bag. What else? And in separate news from China, the inflation data from France and Spain came in lower than expected on Friday. So both figures slipped below the European Central Bank's 2% monetary policy target in September. German inflation numbers are due throughout today, and the Eurozone's aggregate inflation update is due tomorrow. Now, obviously, softening inflation in Europe, combined with the Eurozone's gloomy economic outlook, has actually room to boost the European Central Bank rate cut bets and keep the euro dollar offer near the 112 psychological resistance, even against a broadly softening US dollar. Across the channel, cable consolidates a touch below the 134 level this morning, and the FTSE 100 index there is quite better bid these days. Now, the Chinese stimulus measures are good for the British mining stocks, but unfortunately, the increased negative pressure on oil prices last week heavily weighted on the FTSE 100 index. after the news that Saudi Arabia was looking to change its strategy and focus on increasing its market share rather than trying to prop up these oil prices by taking a lot of production restrictions on its shoulders. Now, the good news is even oil seems to be boosted by the Chinese stimulus news these days, at least since last Friday. So support in WTI is building near the $67 per barrel level. Now, in Japan, the mood is totally different, mind you, since last Friday, because last week's elections in Japan resulted in a surprise win of Shigeru Ishiba, I hope I pronounced that right, who is known for his preference for higher interest rates in Japan. So, the dollar yen tumbled from above 146 to around 142 last Friday, and the pair is consolidating gains near that level this morning, and the Nikkei index tumbled more than 5% on Friday. The index sank below its 200-day moving average, tested the 50-day moving average to the downside, and is back to around its 200-day moving average this Monday morning. Now, happily, I say happily, the 3% slump in industrial production in Japan in August somehow helped taming the yen bulls this morning, but the rest of the economic data from Japan was good enough to keep the downside pressure intact in the dollar yen. So the 140 level is totally within the reach of the yen bulls for the next couple of days and weeks, especially given the sustained selling pressure on the US dollar worldwide. So this brings me to the US. The data released on Friday in the US printed a set of soft inflation data, because the core PCE index, which is the Federal Reserve's favorite gauge of inflation, that data came in line with the market expectations on a yearly basis and was slightly lower than expected and softer than last month's figure on a monthly basis. So the latter actually reinforced the expectation that the Federal Reserve's next move could be a second 50 basis point cut. And that probability currently stands near 55% level. The US 2-year yield remains under pressure, and the major stock indices in the US consolidate their gains near their all-time high levels. Now, Friday's PCE data didn't spark a fresh wave of buying in the S&P 500, but the index renewed record a few times during the course of last week, remember? And the Dow Jones Industrial Index pushed to a fresh high level on Friday's trading session. Now, this week, investors' attention will be shifting to the US jobs data, expected to print another NFP figure near 140K. The unemployment rate in the US is seen stable near the 4.2% level, while the average earnings may have eased significantly from 3.8% to 3.3% on a yearly basis. Now, a soft set of jobs data from the US should keep the Federal Reserve those in charge of the market, given that jobs data will regain all of its importance after the Federal Reserve decided to move its own focus on the health of the jobs data in the US. So the week is going to be very, very important in terms of data for the Fed and for the Fed expectations and for investors altogether. And speaking of jobs, the health of the US job market and its economy, the US ports along the East and Gulf Coast are about to go into a strike this Tuesday in the US as the unions demand higher pay for their workers. Now, the market doesn't seem to be much worried for now, as most goods are believed to be already in for the upcoming holiday shopping season in the US. But obviously, a strike is never good news for supply chains and for goods prices. An extended period of disruption at the US ports could eventually boost the prices of goods that flow into the country from these particular ports, and hence generate an upward pressure on inflation. And a lot of products ranging from raw materials, consumer goods, industrial products, and even pharmaceuticals and medicines are actually concerned. Now, this is all for this Monday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.